Yes, the budget is done, and now we are back to tracking central bankers. The US Federal Reserve is signaling disinflation has begun. How will this impact the Reserve Bank's Monetary Policy Committee meeting? As always, CNBC-TV18 Citizens Monetary Policy Committee meets to discuss whether or should the Reserve Bank hike rates. Joining me now are Chairman Pranab Sen and members of our committees, Sarmilan Chakravarti of Citi, Soumyakant Ghosh of State Bank of India, Sonal Verma of Nomura, and Sajid Chinoy of JP Morgan. Gentlemen and Sonal, thank you very much for joining me. Well, since the backdrop is the Federal Reserve, Sajid, let me start with that. The Federal Reserve is signaling disinflation has begun, and it's a small, only 25 basis hike that we got from them. The ECB and the BOE are still hawkish. So should the MPC still worry that the global banks are hiking and so we can't pause?
Lata, since we last met, the odds of a soft landing in 2023 have actually increased. The IMF, for example, still expects growth to slow in 23, but less than what was presumed a couple of months ago. A lot of this is because China has reopened faster. The data flow in Europe has been better than was expected. So on the markets are more hopeful that growth, the slowdown will be less. We've begun to see the disinflation. We're heading towards some kind of soft landing. But paradoxically, this actually makes the job of emerging market central bankers harder. Why is that? Because you will still see a slowdown. The IMF still expects global growth to go from 3.4 to 2.9 this year, which is a full percentage point below long-term global growth average. And because you will get a soft landing and not a harder landing, it is more likely that advanced economy central banks will be higher for longer and make a type 1 error. If you look closely at what Chairman Powell said, he said they need to see evidence of substantially more disinflation, number one. And number two, they'd rather be in a situation where they do too much than do too little. Both the ECB and the Bank of England were actually very hawkish. So from an emerging market central banker's perspective, this is a difficult combination because growth is going to slow and that will impact India. But at the same time, despite the fact that there is global disinflation, it may not be enough to assuage advanced economy central banks. And therefore, the Fed will keep moving. We think there are at least 2 more hikes coming. The ECB has clearly said another 50 basis points and then more. The Bank of England has more work to do. And more importantly, it's not that when they raise rates and you see a cutting cycle soon, you will see elevated rates for some length of time. And this makes the RBI's job a little bit harder because global financial conditions will remain tight even as the global economy is slowing.
Oh, okay. So it'll be a little tough to blink and say, I'm going soft when global central banks are sounding hawkish. But Samiran, what about the Indian external grammar itself? I mean, we do have a current account deficit. The last number is 4.4, and this year we could end badly. We could end above 3%. So do you think the RBI needs to persist with hikes to slow down imports?
So, Lata, in our view, there are some sort of unexpected good news on the current account front, not so much from the goods trade side, but more from the services trade side. And that prompted us to reduce our current account deficit forecast for the current fiscal year as well as for next fiscal year. So we are now at 2.2% of current account deficit for next fiscal year. Okay. Now, 2.2% is still $85 billion of current account deficit. And that means we require $85 billion of flow just to match the BOP, which in a year, if global dollar liquidity gets tightened, it's not going to be an easy thing to do. So my point is that the RBI cannot take its eyes off this issue. And while we accept that the December quarter BOP might have turned positive, what we are witnessing in January, these sporadic bouts of portfolio outflows, etc., it immediately makes the INR almost a worst performing currency in the EM space in the month of January. So in some sense, if we don't stay along with the rest of the central banks, this problem can persist for longer, elevated by tight global liquidity and idiosyncratic shocks. So even with a much more benign current account deficit forecast, I think this is a factor which the monetary policy cannot completely ignore.
Okay. Well, the year-to-date performance of the rupee versus Asian peers will hopefully come up for you. And this is a quarter where rupee should do well. It's normally a time when export inflows come in. We have 0.75 appreciated vis-a-vis the dollar, but all other currencies have appreciated 2 to 4%, so we are clear underperformers. But deficit, I mean, let's not forget we have this big budget just behind us, and one of its excellent performance has been on the fiscal deficit front. It has got all-round praise. So, Soumya, on that, if the fiscal is tightening and we have a slowing economy, should the RBI also persist with slowing the economy? Can they pause?
Yeah, thank you, Lata. I think that's a very relevant question because all through the pandemic, we have seen that the monetary and fiscal policy have worked in coordination. So, whatever actions the monetary has taken, the fiscal supported it. Now, the question comes is that the fisc is actually decided to go on its path of fiscal consolidation. Borrowing numbers are in line with market expectation, are in fact lower than the market expectation, slightly lower. And given the fact that as Shamiran pointed out, rupee disturbances, but my sense is that it is also has to do with the RBI significantly recouping forex reserves. Forex reserves now almost recouped more than 60% of the lows. So that could be one of the factors which is holding back and rupee appreciation. But the limited fact is that in an economy where Fed is also slowing their rate hikes, possibly Fed could do another rate hike but of the same magnitude.
My point is the borrowing. I wanted your view on the borrowing program. The borrowing program is a little more controlled, at 15.5. So, can the Reserve Bank...
Yes. So, basically, if you specifically look into the borrowing program, I think if you look into the composition of the GSEC program, the RBI and the banks and the insurance companies subscribed around 60% of the overall pie. Now, in an economy whereby in the next year, if we actually look into the question of this subscription, it is possible that every time the banks or the insurance companies may not have the appetite to subscribe to the 60% of the overall pie, even though the pie may not have gone significantly earlier. So, if you just do a small dipstick estimates, I think there could be still a shortfall around 2 to 2.5 trillion of amount of GSEC which has to be taken out from the market by somebody else rather than the marketplace. So, I mean the central bank. So, in that case, I think some sort of a liquidity support could be required because we know that because of an HTM and not adequate HTM space, given the fact that also the appetite of the borrowing which has happened last year for the insurance companies, that may not remain this time. So, under such a circumstances, I am not sure whether then continued policy tightening or liquidity tightening could help the cause of the markets, even though given the fact that inflation is coming under control.
Okay, sorry, I think I have asked two questions in one. One is the growth support and one is the borrowing support. We'll discuss the liquidity again. But let me come to the core problem of the Reserve Bank and the MPC, the inflation targeting. Sonal, on that, I mean, inflation has actually come in lower than expected for both the months of November and December. So for October, November, December, it's below what Reserve Bank forecast. So do you think the Reserve Bank can relax a bit? And anyway, there's disinflation in other economies as well.
It's definitely a positive, Lata, the headline coming down, but the details, of course, show that it's the more volatile components of inflation, like vegetables, which have driven this. The core basket on aggregate is still sticky, but even there, like if one splits out into the details, the commodity side of the core basket, the super core, as we call it, momentum, which was trending around 6% on an annualized basis, in the month of December has actually come down to around 4.5% on our estimates, but it's just 1 month. So per se on inflation, yes, headline coming down is good, but core is still sticky. Having said that, I think from a forward-looking perspective, the signals do suggest that there should be faster disinflation in FY24 because even within the core inflation, the core services part of the basket actually are showing faster disinflation. It's really the core goods part of the basket which is still sticky. And given the moderation in commodity prices, notwithstanding China reopening, plus the negative growth we are seeing on the export sector, the moderation in industrial production side, so the goods side of the economy is slowing down alongside a moderation in input cost pressure. So I think forward-looking indicators do suggest that goods part of core will also moderate. So I think it is less of an issue for sure compared to back in December. The details are more mixed, but the forward-looking indicators are also positive.
Okay, but you know what, Sonal, there are two views on this. There are people who still worry that core is not going to come down. I'll debate that a little later and get other people's views. But let me get the chairman's views. Chairman, as always, you've focused on growth in the past. Now, as the others have pointed out, there are enough growth breakers already coming in terms of the global scenario and global central banks. So do you think this once the Reserve Bank and the MPC should pause in aid of growth?
Lata, in any case, I think the growth momentum is going to slow down quite substantially. And I think we are in a situation now, at least the RBI, given that the budget is now unknown, the RBI is in a situation that it doesn't quite know which way to jump. And so if I were the RBI, I would be playing my cards very, very close to the chest, because much is going to depend upon how effectively the fisc is being managed in the coming months. But the simple fact of the matter is that I think the basic inflationary momentum is now significantly weaker than it was. And therefore, I think the focus can now be a little more balanced than it was earlier.
Oh, okay. Well, I need to, flush all these points a little more with all of you, but we are out of time on Bazaar. So we say goodbye to our Bazaar viewers, but you will get to hear the entire conversation of the MPC later on after market hours, along, very importantly, with how they are going to vote. It looks like it's going to be a divided vote this time. We're taking a break and we're coming back.